Welcome back everyone to the Money Control live stream. You're watching Markets with Santo and CJ. And Santo, I pray for days like this, on a day when it seemed like we are going to have a very muted start, it looks like bulls have single-handedly grabbed the initiative and taken the day for themselves. If you look at the market, the Nifty just blitzed past the 17,500 mark, which was, if you remember last week, you were talking about the fact that that could be a very, crucial resistance. And Nifty and Sensex sitting at pretty at 4-month high. Santo, the risk appetite is looking quite strong. If you look at, what is driving this, at this point of time, it clearly seems like foreign investors are back on these shores. And clearly the growth outlook, the fact that the growth outlook has remained largely in line with what people were expecting, and earnings downgrade have not been that hefty. I think that has brought a lot of investors back to these shores, along with the valuation comfort that the market is providing.
Valuation? Did I hear valuation?
Yeah,
comfort?
I think so. I mean, come on, we had seen Nifty PE come down from 23 to almost 17, 18. So clearly, in terms of
at this
PE,
stage, CJ, I think it's market swinging between two extremes. Either it's paranoia or suddenly you're moving to exuberance. I think
exuberance is too strong a word to use.
No, that is because you're comparing it with the peak of last year, the all-time high of the market. But if you look at from an earnings perspective, as well as the fact that money is only expected to get tighter here on, and that commodity prices
but isn't that a testament to our market? The fact that money is so, so dearer, and still we are almost sitting 800, 900 points away from record hikes.
Well, I would say that at this point, again, there could be a certain FOMO element as well here at play.
Okay.
CJ, very clearly, when prices are moving up sharply, people would like to think that maybe, they have missed out on the getting on at the very low, and now probably are trying to compensate for that. But that said, CJ, you got a very strong US labor market at this point in time, which means that the Fed will really struggle to keep a lid on inflation, which means that there's no other way but to keep on hiking rates, given that it has made it amply clear that controlling inflation is its primary target. So look at this, you got higher rates and the fact that the Fed is also cutting down on its balance sheet. I mean, all these are known. I'm not saying anything new here, but these are also reality. The market has just seemed to look beyond that. It's as if the rate hikes and that tighter liquidity won't be there at all. So it may be discounted here. No argument. The prices are moving higher. There's no point in saying what's when the market just not willing to look at that. But that said, I think there's a need to exercise a bit of caution rather than getting carried by FOMO at this stage. Probably you again need to look at cleaning the duds in your portfolio. It's a good time for that.
I think, Santo, you can always flip the argument the other way, right? I mean, we got into this rate hiking cycle with this entire fear that, the economy will not be able to handle it, right? You had in the US, you had people talking about a recession happening. In India as well, when the RBI had that emergency rate hike, it just took the floor off the market. Everybody feared that, oh shit, we have not really recovered yet, and you are already seeing the the central banks hiking rates so far. But almost 4 months now into the rate hiking cycle in the US, or almost 3 months here, and we have not seen any evidence that rate hikes are impinging on growth. And I think that is where this new wave of buying is coming in. I think the market is climbing the wall of worry. I think the market is realizing that maybe the central bankers are right in saying that the economy is strong enough to take the rate hikes that they are doing, and therefore they are justified in going against inflation without worrying too much about growth. And I think you saw that in the commentary of the RBI. We have seen the Fed maintain that position quite strongly over the past 3 to 4 months, and maybe that is the reason why we are seeing the sort of buying that we are seeing.
Very much possible, like absolute interest rates don't actually matter, because if you see back in the 90s, you had interest rates at 16% plus. It's how much, companies are and investors are able to make about that.
I mean, but that said, one of the very famous, fund managers in the US, Dennis Gartman, actually earlier today, I had seen flashes on Bloomberg suggesting that market could fall 20% from current levels by the year end. So you don't know where the doomsayers are back calling for another.
There's no dearth of them, and I think that's the cautious mood. That said, let's quickly take a look at the stocks on our watch list this afternoon, starting with BPCL and HPCL. CJ, till a month back, I still thought there was some hope for these companies. Probably the valuations were in their favor. But now looking at the latest quarter number, it's very clear that the marketing losses are weighing very heavily on both these companies. And the big issue here is that it's the government policy, according to analysts, which is really hurting these companies. And till that is addressed, you don't really have much cause for hope here. You're not just betting against a a change in the cycle, or probably crude oil prices softening here, unless the government decides that it really needs to allow these companies also to make some bit of money. Investors are not really going to be happy with these stocks. So that said, I would be very cautious. The latest quarterly numbers clearly indicate that there's a much higher losses, operating losses, than what analysts were expecting it. And while these stocks are now available at just about their book value, it's very doubtful if they could see any meaningful upsides from these levels.
So Santo, I'm also very torn. I mean, in between. I mean, if you look at the earnings performance, clearly there is just doesn't seem like there is any hope at this point of time available for a company like BPCL or HPCL out there. But then if you pick up the carpet a little bit, I think you can see a little bit of hope. The only hope comes from the fact that, of course, you have seen global crude oil prices come off from at the peak of almost $125 per barrel to almost $95 per barrel, right? You also at the same time have refining cracks also coming down quite lower. So, and the fact that demand has been quite strong. I mean, if you look at the throughput of BPCL, or if you look at the volumes for BPCL and HPCL, clearly there is demand out there. It has not really, the higher prices have not really impinged on demand that much.
I don't think that is the issue, CJ. The issue
so
again
my point is if oil prices do soften on a sequential basis, then of course the oil marketing losses that they have been suffering, that could come down for them. I mean, so far, according to HPCL and BPCL, they have not seen under recovery losses in petroleum. So that is one
but they're still losing about 15 rupees on diesel, every liter of
diesel.
So
if prices do come off, prices do come off on a sequential basis, I think there is an argument to be had that maybe the marketing losses could start going lower and lower. I mean, you had Ambit Capital coming out and saying that they expect BPCL to actually have normalized marketing income from FY24 onwards. Of course, FY23 probably is a washed year in that sense, because even if the situation now changes from today, it will take the entire year to recover the losses that they have suffered in the first quarter. But FY24 onwards, Ambit Capital is expecting a normalized year as far as marketing margins are concerned. And the other part about BPCL is that, Santo, their refining throughput or capacity at this point of time is running at 111%, right? So basically everything is going full throttle, and they have a higher exposure to middle distillate refining products. So on both those fronts, if oil prices continue to soften, I think they could probably be able to make some money or recover some money going ahead. And their higher return on capital also, compared to an IOC and an HPCL, also makes them a preferred bet according to Ambit Capital compared to the other two.
Well, see, it's a very strange balance. On one side, if actually you have crude oil prices come off, it means that your marketing losses will no doubt reduce a bit, but at the same time it also means that you will be making less money on your refining business. And since marketing is a bigger chunk out there, easing of crude oil prices, I don't know to what extent it will really spell relief to this company.
I think the play here would be sequentially you keep on saying, what Ambit is trying to say is of course year on year basis you're going to see losses, because of course crude oil prices will be higher still on a year on year basis until unless we reach towards the end of the year when oil prices had started inching towards the $80-85 per barrel mark. But on a sequential basis, because we are going to come off from a high of $125 dollar per barrel, I think sequential basis you could see some softening of the marketing losses, and that could aid the bottom line, because in terms of top line, we have seen that there has not been any concern for both the companies. I mean, the revenue and top line performance was very, very strong. It's just that the operating losses is where, because the money that they are making from the refining business is getting clearly trumped by the marketing losses that they're suffering. So if marketing losses were to get lower, and refining business were to remain probably at the same state, then you could see some bit of improvement going ahead. So that is the limited argument that I think Ambit had. But of course,
you call that a limited argument? This was one hell of an argument.
But yeah, I mean, personally, I still remain quite, divided on the fence on where these two stocks are going to head to. One stock where I am not at this point of time undivided at all is Metro Brands. Clearly, a very stellar quarter for the company. We have seen it in the stock performance as well. And I mean, the company came out with almost the best ever quarterly performance that they have seen in the June quarter of FY23. Their expectation is that this performance can continue in the coming quarters as well. If you look at what Centrum Broking had to say, which has a buy rating on the stock, they said that they are expecting net profit to grow at a compounded rate of about 47% annually over the next 3 to 4 years. So clearly, this is one stock that is in a growth phase and is, having that growth and generating a lot of cash and doing it at a very healthy manner. So clearly, investors would be very, very, lucky to have this stock in their portfolio at this point of time, the way the performance has been so far.
Well, my only quibble remains valuation, but it's no point arguing on that front, given that prices have risen very sharply over the last month, almost a 40% rise.
Yeah, I mean today itself the stock is higher by 3% almost.
So June quarter numbers no doubt were quite strong, and that's what got investors very excited about the stocks. But I would just look at the fact that stock right now on a trailing 12-month basis is quoting at about 63 times, and if you look at the last 5 years sales growth, it's been a little muted. It's been just about 5%, even adjusting for the COVID years, probably it could have been somewhere around 10%, and you're still giving it a very high P. That said, I don't know, maybe the market is looking into the future.
I think the market is looking at a faster growth period for the company in the next 2 to 3 years.
Possible,
I think that is the reason why we are seeing. I mean, the high PE right now, trailing PE could of course be caught up if your EPS grows faster than in the coming years, and maybe then probably the valuation will look even more reasonable.
Well, next stock on our watch list is Shriram Transport Finance. A decent set of numbers, though there was a miss at the bottom line level. That was largely because the company had to make higher provisions, but overall the demand scenario looks quite good. And in fact, Umesh Revankar of Shriram Transport Finance was on the channel earlier today, and he said that the growth market for used vehicles is pretty strong at this point in time. He is also guided for a 12% growth in AUM this year. Besides that, if you look at the comparative growth in AUM, it has shown a growth both quarter on quarter as well as year on year, and disbursement has also been up close to about 30% year on year. Collection efficiency has been strong. Now, right now Shriram Transport Finance is mainly into the financing. Used vehicles is its major forte, but after the merger with Shriram City Union, its overall portfolio gets bigger, and at the same time it's able to retain its niche, because even then used vehicle finance will still account for a fairly sizable chunk of the portfolio. So it's like kind of having the best of both worlds, CJ.
Yeah, Santo, I mean the stock has been doing quite well, of course, with the entire recovery that we have seen in the CV space as well. We were one of the drivers for Shriram Transport Finance, and of course if you look at the management commentary, they have not seen much slowdown in demand, even in the rural markets as well. My only concern would be the fact that, going ahead with interest rates having risen so much, on the repo rate, and of course that will slowly and steadily trickle down in terms of the lending products that the company has. I fear that probably demand could start getting hurt a little bit going ahead. Also, let's not forget that they do cater towards the lower strata of the society in terms of income, lower to mid-range, and clearly in that section of the society, higher EMIs of course then become a challenging issue, and then you could see your incremental decision making getting probably hurt by the fact that interest rates are going to be higher. So that would be my one concern for the company going ahead. And apart from that, I think the FY23 guidance, Santo, of a 12% growth in AUM just seems a bit moderate to me, given that there are NBFCs out there or there are stories out there within the NBFC space which are providing much better, growth opportunities. Maybe there may not be a niche player like Shriram, but a player like Bajaj Finance clearly offers a better growth opportunity for me than Shriram Transport.
Well, CJ always starts with saying I have this one problem, and then goes on to list 2 or 3 more.
What can I do? I just end up remembering 2 or 3 more. Well, my last talk on the show today is Hubtown. A real estate play. It's a turnaround story that I spoke about almost a month ago as well, and since then the stock has risen about another 7 to 8%, and clearly today the stock was very much in action, higher by almost 10%. I think it was quoting at its upper circuit, Santo, today. And I think one trigger that people are waiting for is the fact that I think there is some reportage out there. The companies are waiting, clearance certificate from the authorities, Mumbai authorities, in terms of one of its largest projects or residential projects in town. So clearly, if that clearance certificate comes in, that will be a very major trigger for the company. And apart from that, of course, Hubtown's the entire story has revolved around the fact that it has very good land parcels all across the MMR region or the Mumbai metropolitan region, and along the fact that they are also getting into or have tried to recast a lot of their debt from the past. So those 2 factors being in play, and with the clearance coming out for the new project, I think this is one stock that investors ought to keep in their watch list going ahead, Santo.
Well, to turn one of the argument against you. Rising rates. That's the biggest negative for real estate in general.
Yeah, but we are not, we are not hearing from banks and all. I mean, I think recently Kotak Mahindra Banks, one of their senior management had an interview with one of the publications. They said that so far they have not seen any impact on, home loan demand, despite the fact that we have seen almost 90 basis before last week's rate hike. We have seen almost 90 basis up move in home loan rates, but they have so far not seen any demand. So I think that there is still some room to maneuver as far as home loans are concerned. Santo.
Well, interest in the stock has suddenly picked up because of its strong March quarter numbers. That's where the kind of turnaround seems to have happened. Now we don't know if it can sustain, but certain people either they know for sure or probably are going and betting that
I think there is cause for optimism on this,
and some bit of probably informed buying also, as I would like to call it, when a stock with very little volume suddenly starts shooting north. So that's the case with Hubtown. So clearly there is interest in the stock at this point in time. Just the caution here would be that it's a bolt from the blue, literally, on the positive sense. So the vertical takeoff in the stock price. At the same time, we are still not clear if this can sustain.
But Santo, I know certain market participants out there who have been talking about the stock since last year, since last July. So for them, I mean, this has been a story coming. It's just that now it is coming in the headlines and the media. So sometimes, the gold hunters or gold diggers out there have really nabbed a stock that really is going to probably make a lot of money for them.
Well, last stock on our watch list is Raymond. It was a kind of a turnaround story, and it probably still is a turnaround story. The slight disappointment here is that the management had sounded very positive about the June quarter while guiding at the time of the April quarter numbers. It had said that mainly, the marriage season, the June quarter is
be a driver,
yes, that was expected to be the big driver, but that somehow doesn't seem to have reflected in the company's first quarter number. Now,
I wonder what happened. Like the groom started, like Dula Raja was like, "Nahi, nahi, mere ko nahi pehna hai suit boot, mere ko nahi pehna hai."
Now the company says that it is a record Q1 quarter, and actually there's a sequential drop. So it's true, it's a record Q1 quarter, but if you compare the quarter on quarter growth, there's a drop there. And if you see, the stock had kind of topped out about in May, it hit 1000. There was huge volumes in that stock, and ever since that it had hit 1200, I beg your pardon, and ever since that it's been coming off. Volumes have kind of been steady, but appetite for the stock appears to have waned a little bit. After, of course, the stock also had a fairly good run up. You can't ignore that either.
I think, Santo, there has been, of course, a decent amount of profit booking on the stock since May, and you can clearly see that in the 2-month or 3-month chart of the company. But I think for me, overall, I think the story still remains. I think for Raymond, of course, although the textile business, of course, is the main driver, I think the fact that they had all these land parcels that they had, I think if they are successful in monetizing, they have already been successful in monetizing a part of it, but if they're successful in monetizing a lot of the other land parcels, especially in areas like Thane that they have, I think that could probably be a very good trigger for growth going ahead for the company. And in terms of technicals as well, yes, near term, if you look at it, it looks quite bearish. But from a weekly point of view, Santo, I think the weekly and long-term technical indicators point of view, they are both showing that the bullishness is likely to sustain for the stock, because the major breakout, the multi-year breakout that the stock had given last year, that clearly is still in play. And I think investors, maybe at this point of time, the stock is taking a bit of a pause, and I will not be surprised if we see another jump in the stock going ahead.
Well, tomorrow markets will remain closed for trading on account of Muharram, and we'll be back again on Wednesday. But what is that we have to look forward to there?
Well, Santo, there are a few nifty earnings on Wednesday, so we have to watch out for them. You have Coal India and Hindalco coming out with their Q1 numbers, and one stock that you and I always log heads over, IRCTC. That is also going to come out with its Q1 earnings on Wednesday. Apart from that, of course, we have some earnings coming out later in the evening as well. So a lot of earnings, because we are getting towards the last 3 or 4 days of the earnings season, you will see, almost hundreds of companies coming out with their earnings on a daily basis for the next 2 to 3 sessions. So clearly that is something to watch out for. And I think apart from that, on the economic front, we don't really have too many triggers out there, neither today nor tomorrow or for Wednesday. So looks like a very, very stock specific market going ahead in the coming days.
Well, all three stocks pretty interesting, Hindalco especially, it's been a
I
very
think
sharp,
Hindalco is going to be a
very sharp bounce
interesting
back. So the
earnings to watch
numbers
out
would be
for.
worth watching
Yeah, I
out.
mean, Novelis earnings are very
Already,
strong.
even IRCTC for that matter has made quite a good comeback. In fact,
Yeah.
platform stocks in general have been doing quite well.
I think it is
for the
happening in general with technology and internet platform stocks all across the board. If you look at Nasdaq as well, I mean, Nasdaq's bounce back since the the lows of the mid June has been spectacular, and we have seen that in Paytm as well. I mean, Paytm is up 62% after today's almost 7% move on the counter. So clearly, I think a lot of people who call the bottom there have made are going to head into a very happy Independence Day.
Well, with that, it's a wrap on this edition of Markets with Santo and CJ. Thank you for watching, and please do let us know what you think about this show. Share your feedback in the comment section below.
And as usual, guys, keep following us on the social media links that you can see at the bottom of your screen. And for the rest of your financial news, stay tuned to moneycontrol.com and download the Money Control app. We'll catch you again live Wednesday morning at 9 a.m. Till then, have a great trading, whatever is left, and of course, enjoy the Muharram break.